Retirement in 2026 may become one of the biggest financial opportunities Americans have seen in decades, and most people still do not fully understand how many tax rules changed at the same time. The reason this matters so much is because several major tax benefits are now working together in a way we have not seen before. Lower permanent tax brackets, larger deductions for seniors, expanded Roth conversion opportunities, higher SALT deductions, and new estate tax protections are all active together right now. For retirees, that combination could mean keeping thousands of extra dollars instead of sending them to the IRS. The first major reason is the federal tax brackets themselves. Back in 2017, the Tax Cuts and Jobs Act lowered tax rates across the country. The 12% bracket replaced the old 15% bracket, and the 22% bracket replaced the old 25% bracket. But those lower rates were temporary. They were originally scheduled to expire after 2025. If Congress had done nothing, millions of retirees would have suddenly faced higher federal taxes beginning in 2026. That did not happen. The One Big Beautiful Bill Act permanently locked in the current tax bracket system. The 10%, 12%, 22%, 24%, 32%, 35%, and 37% brackets are now permanent federal law. There is no longer an expiration date hanging over retirees trying to build long-term financial plans. On top of that, the IRS increased the 2026 bracket thresholds again for inflation. Single filers can now stay inside the 12% bracket up to $50,400 of taxable income, while married couples filing jointly can remain there up to $100,800. That matters because retirees often live on fixed income sources like Social Security, pensions, and IRA withdrawals. A wider 12% bracket gives retirees more room to withdraw retirement funds or complete Roth conversions while paying lower taxes. For someone withdrawing $40,000 annually from a traditional IRA, avoiding a return to the old 15% rate could save around $1,200 every single year. Across a 20-year retirement, that becomes tens of thousands of dollars, kept instead of lost to taxes. But the biggest benefit is stability. For years, retirement planning came with uncertainty because nobody knew whether tax rates would suddenly rise again. Financial planners constantly warned clients that calculations assumed current law. Now retirees finally have a predictable system they can actually plan around. That changes everything for long-term retirement strategies. The second major change is the new senior bonus deduction. This did not even exist a few years ago. Under the new law, Americans aged 65 and older receive an additional $6,000 deduction per eligible person. Married couples where both spouses are over 65 can claim a combined $12,000 deduction. This comes on top of the regular standard deduction and the existing additional senior deduction. For a single retiree in 2026, the standard deduction is $16,100. The extra senior deduction adds another $2,050. Then the senior bonus adds another $6,000. Combined, that gives a total deduction of $24,150 before federal taxes even begin. A retiree earning $68,000 could reduce taxable income down to about $43,850, safely inside the 12% bracket. For married couples, the numbers become even stronger. The standard deduction is $32,200. The additional senior deduction equals $3,300 combined, and the senior bonus adds another $12,000. Altogether, that creates total deductions of $47,500. A retired couple earning $60,000 may end up paying only around $1,250 in federal income tax for the entire year. That is an incredibly low effective tax rate. However, this deduction is temporary. It currently lasts only through 2028. That means retirees entering retirement in 2026 have a short window to maximize the benefit before it disappears unless Congress extends it later. The third reason involves the SALT deduction, which stands for state and local taxes. Since 2017, homeowners in high-tax states have been limited to deducting only $10,000 in state income taxes and property taxes combined. millions of homeowners stopped itemizing deductions because the math no longer worked in their favor. That changed dramatically under the new law. Beginning in 2026, the SALT cap increased to $40,400. For retirees living in states with high property taxes, this can completely change filing strategies. Imagine a retired couple living in New York with $18,000 in property taxes, $12,000 in state income taxes, $6,000 in mortgage interest, and charitable donations during the year. Under the old rules, only $10,000 of those taxes counted, but under the new law, much more becomes deductible. Suddenly, itemizing deductions may become more valuable again than simply taking the standard deduction. For many retirees, this could save hundreds or even thousands of dollars annually. And the important point is that many people still have not rerun the numbers since the law changed. They are automatically taking the standard deduction simply because that became normal after 2017. The fourth reason is one of the least understood opportunities in the tax code: the 0% capital gains bracket. In 2026, if taxable income stays below $49,450 for single filers or $98,900 for married couples filing jointly, long-term capital gains are taxed federally at 0%. This creates an enormous opportunity during the first retirement year. Why? Because many retirees stop working halfway through the year, meaning total income temporarily falls. That lower income may allow them to sell appreciated investments without paying federal capital gains taxes. For example, a retiree who worked only part of the year may end up with enough room to realize over $40,000 in investment gains tax-free. They can sell stocks, mutual funds, or other investments, then immediately repurchase them at the new higher value. This resets the cost basis and reduces future taxable gains later in retirement. Most retirees completely overlook this strategy, even though it can save thousands of dollars over time. The fifth reason is probably the most powerful strategy available in 2026: Roth IRA conversions. When retirees stop working, income usually drops sharply. That creates a rare opportunity to move money from traditional IRAs into Roth IRAs while paying taxes at historically low rates. The expanded 12% bracket makes this even more attractive. A single retiree in 2026 with low income may be able to convert tens of thousands of dollars from a traditional IRA into a Roth IRA while staying entirely inside the 12% tax bracket. Why does that matter? Because traditional IRAs eventually create required minimum distributions beginning later in retirement. Those required withdrawals can push retirees into higher tax brackets. But Roth IRAs grow tax-free forever and do not require minimum distributions during the owner's lifetime. Imagine converting $54,500 today while paying taxes at 12%. That tax bill may total around $5,800. But waiting until later, when required distributions push income into the 22% bracket, could create taxes approaching $12,000 or more on the same money. That difference represents thousands of dollars saved simply because the conversion happened earlier. Roth conversions also create long-term estate planning advantages because heirs inherit Roth accounts income tax-free. The sixth major reason involves estate taxes and inherited assets. One of the biggest fears among retirees has been the possible elimination of the stepped-up basis rule. Fortunately, the new law preserved it. The stepped-up basis means heirs inherit assets at current market value instead of the original purchase price. Suppose someone bought a home decades ago for $120,000 and it is now worth $450,000. Under stepped-up basis rules, heirs inherit the property at the current value. If they sell immediately, they may owe no capital gains tax at all. The same applies to investments. Families can avoid enormous tax bills because decades of appreciation disappear for tax purposes at death. In addition, the federal estate tax exemption increased to $15 million per person and became permanent under the new law. Before this change, the exemption was expected to drop dramatically after 2025. Now, most American families remain safely below estate tax levels, even with paid-off homes, retirement accounts, and investment portfolios. That gives retirees more certainty when planning how wealth transfers to children or grandchildren. The seventh and final reason is simple, but extremely important. 2026 is the first full calendar year where all of these benefits exist together at the same time. The lower permanent brackets, senior bonus deduction, expanded SALT cap, wider Roth conversion window, 0% capital gains opportunities, and larger estate tax exemption all apply simultaneously for the entire year. That creates what many retirement planners consider a financial sweet spot. Several of these benefits are already scheduled to shrink later. The senior bonus deduction expires after 2028 unless renewed. The SALT deduction begins changing again later in the decade. Roth conversion opportunities become more expensive each year as IRA balances continue growing. That means delaying retirement or delaying tax planning could become costly. A retiree who waits several years may lose deductions, face larger required distributions, and pay much higher taxes later. Consider the total picture for a retiree earning around $45,000 annually in 2026. Between the standard deduction, and senior bonus deduction, taxable income may fall dramatically. Combined with lower permanent tax brackets, that retiree could end up paying only a few $1,000s in federal taxes for the entire year. Add a well-timed Roth conversion or tax-free capital gains harvesting, and the long-term savings become even larger. The important point is this: none of these opportunities are secret. They are written directly into the tax code. But most retirees never hear about them clearly explained. And the IRS is not going to personally notify people about strategies that may legally reduce taxes. That is why understanding the rules matters so much right now. The retirees who benefit most are usually not the wealthiest retirees. They are the retirees who actually learn how the system works and take action while the opportunities still exist. 2026 is shaping up to be one of the strongest retirement planning years in modern history because several major tax advantages finally overlap together in one place at one time. Lower permanent brackets, larger deductions for seniors, expanded investment tax breaks, stronger Roth conversion opportunities, and better estate protections are all available together right now. For retirees, that could mean the difference between barely keeping up with inflation and protecting thousands of additional dollars throughout retirement.